Have you ever wanted to know the expected return of an investment based on its risk? Of course you have. Welcome back to the Industry Portal's Finance Explainer series, where learning finance is made simple. In this video, we're diving into a topic that's super important for anyone investing in stocks or analysing risk: the Capital Asset Pricing Model, or CAPM for short. And although the term CAPM might sound a little intimidating, don't worry, we're here to break it down step by step. By the end of this video, you'll know what CAPM is, how it works, and why it's such a powerful tool for investors. So let's dive in. So what exactly is CAPM? The Capital Asset Pricing Model is a formula that helps investors calculate the expected return of an investment based on its risk. The key idea here is that higher risk should come with higher potential returns, and CAPM gives us a way to quantify that relationship. The CAPM formula is as follows. Expected return equals risk-free rate plus beta multiplied by the market return minus the risk-free rate. So let's break this down piece by piece. The risk-free rate is the return you'd get on a completely safe investment, like a government bond. It's the baseline because it represents the minimum return you'd expect for taking no risk. The beta measures how risky the investment is compared to the overall market. So a beta of 1 means the investment moves exactly with the market, while a beta greater than 1 means it's more volatile. For example, a beta of 1.5 means the investment is 50% more volatile than the market. The market return is the average return of the entire market. So think of something like the S&P 500 or the FTSE 100. And the market risk premium is the difference between the market return and the risk-free rate. So it tells us how much extra return the market is offering for taking on risk. Now let's plug in some numbers to see the CAPM in action. Imagine you're considering investing in a stock with a beta of 1.2. The current risk-free rate is 3%, and the expected market return is 8%. Using the CAPM formula, we calculate expected return as 3% plus 1.2 multiplied by 8% minus 3%. So first, we calculate the market risk premium, which is 8% minus 3%, which gives us 5%. We then multiply it by beta, so 1.2 multiplied by 5%, which gives us 6%. And finally, we add the risk-free rate, so 3% plus the 6% gives us 9%. So according to the CAPM, the expected return for this stock is 9%. But what does that mean? Well, it means that this stock needs to generate at least a 9% return to compensate you for its risk. If you think the stock will earn less than 9%, it's probably not worth the risk. If you think it'll earn more, it could be a good investment. Now, why is the CAPM so important? Well, firstly, CAPM helps investors make better decisions. It gives you a clear benchmark for evaluating whether an investment's potential return is worth the risk. Instead of guessing, you have a formula to guide you. Secondly, CAPM is widely used in portfolio management. Professional investors and fund managers use CAPM to build portfolios that balance risk and return. By understanding how different assets fit into the overall market, they can make smarter decisions about where to allocate money. And thirdly, CAPM helps companies calculate their cost of equity. When businesses raise money by selling shares, they need to offer investors a return that compensates for the risk of owning the stock. CAPM gives them a way to calculate that return. But like any model, CAPM isn't perfect. It's based on assumptions, like the idea that markets are efficient and investors are rational. In the real world, things don't always work that way. However, it's still an incredibly useful starting point for analysing risk and return. So here's a quick analogy to sum it up. Imagine you're buying a car and you want to know if you're getting a good deal. CAPM is like having a price comparison tool that shows you what you should expect to pay based on the car's features and condition. It's not perfect, but it gives you a solid benchmark to work with. With that said, let's recap. The Capital Asset Pricing Model, or CAPM for short, calculates the expected return of an investment based on its risk. The formula is expected return equals the risk-free rate plus beta multiplied by the market return minus the risk-free rate. CAPM helps investors decide whether an investment's potential return is worth the risk. It's widely used in portfolio management and corporate finance to evaluate risk and return. And that's it. CAPM explained simply. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.